Welcome, dear traders. After volatile session on Wall Street, futures for the US stock indexes appreciated in the Asian session. Asian stock markets also climbed. All three benchmark indexes snapped their 3-week losing streak following remarks of several Fed policymakers on key rates. Traders wonder why stocks are now growing on hawkish statements, and they were down because of them earlier. Let's figure it out. At the start of the US session on Thursday, the US stock indexes were trading without a clear-cut trend. On the top of that, investors had already heard statements from several Fed officials backing further monetary tightening. Some comments in their speeches were quite worrying. Jerome Powell's speech seems to have dispelled all doubts. The Fed chair warned against loosening monetary policy early. He said price stability is the Fed's responsibility. History cautions strongly against prematurely loosening policy, so the Fed is strongly committed to the project and will keep at it until the job is done. Therefore, after Powell's speech, investors no longer doubted further monetary policy tightening. The prospects for the equity market became clearer and more stable. Investors have already priced in another 75 basis point rate hike in September, as well as further rate increases. This is confirmed by the CME FedWatch Tool, revealing that the probability of a 75% rate increase on September 21 has already reached almost 90%. The US dollar is enjoying high demand amid the Fed's hawkish course. Yesterday, President of Chicago Fed, Charles Evans, noted that bringing inflation back down to the 2% target is the top priority. The US currency is steadily climbing versus its rival amid its safe haven status, subdued recession risks, and aggressive tightening. So it's hardly surprising that the greenback has already reached new yearly highs amid these drivers. However, it had to retreat due to rising stocks. In the Asian session, the US dollar index lost 1%, declining to 108.47. It locked the 30th consecutive decline, moving in the sideways channel of 108.40 and 109.54. The consumer price index is due next week. Given the Fed's strong commitment to monetary tightening, this report will hardly affect its rate decision. However, the CPI data will surely have an impact on the US dollar. Meanwhile, the dollar-yen pair is extending losses. In the middle of the week, the Japanese currency approached a 24-year low. Since the start of the last year, it has depreciated against the US dollar by almost 30%. The yen has been declining amid expectations of rate hikes by the Fed and low rates in Japan. Those predictions turned out to be accurate. A rapid fall in the yen has already spooked large investors. This is why the yen has been losing its appeal with the traders for some time. It's led by almost 3% this week, even though there were no particular reasons for it. Japanese policymakers have made verbal interventions. However, investors do not take them seriously, doubting that the regulator could really intervene. And this is why the comments of Bank of Japan officials have almost no impact on the trajectory of the yen. Analysts believe that the yen is declining rather rapidly, so a breakout of the pivot level of 144 looks quite likely. And the yen is not the only currency that is losing momentum against the US dollar. The latter has also strengthened to multi-year highs versus the euro and the pound sterling. Yet a drop in the yen has been the steepest, as the Bank of Japan is the only regulator that sticks to an ultra-loose stance. Nevertheless, speculators are well aware that the market's reaction to changes in the monetary settings will be rather sharp. However, these fears remain subdued today. The yen was gradually rising amid the consolidation of the US currency in the Asian session, and the pair tumbled to 142.23, moving in the bear corridor of 142.05 and 144.12. The Aussie perked up steam as well. It advanced following the recovery of Wall Street. As a reminder, the Australian dollar has a high correlation with the USDX. Today, it's trying to recover some of its early losses, and the AUD USD pair added gains, trading in the upward into the range of 0.6747 and 0.6875. In the Asian session, it approached 0.6873. And let's not forget that the coronavirus situation in China has a huge impact on the Australian markets. China is now experiencing a downturn as it has to impose tougher quarantine restrictions. China's economic woes have adversely affected Australian markets. Exports of iron ore contracted by minus 15% and exports of coal shrank by 17%. Another bearish factor is the foreign oil prices. Concerns about a slowdown in global economic growth are going to weigh on the Australian dollar. Major central banks continue to aggressively raise interest rates to cap inflation. Therefore, the outlook for the currencies of the Asia-Pacific region remains bearish. And that's all for now. Subscribe to our channel and keep close tabs on the market developments with us. See you soon.